Hi, everyone. I'm James Garbutt,
And I'm Denny Dumas.
and this is the Garbutt Dumas Real Estate Podcast.
We've seen the Bank of Canada overnight rate go up again for the third time in a very short period, another 0.5%. And what that means is likely the banks will follow. This is typically what happens. And the prime rate will increase about 0.5% in a day or two.
So just to kind of follow that pattern, it bottomed out in March 31st, 2020 at 2.45%. That's a Canadian prime rate. And it went up to 2.7 in March 3rd, 2022. Then April 2022, it started increasing drastically. So this year, March, it went up to 2.7. Then April, it went up to 3.2. And now it's been announced that it's going to 3.7%.
Yeah. What does that mean for consumers? What are our predictions? I think we just like to kind of share what is the outlook on summer and into the fall of 2022 in the real estate market in Greater Vancouver based on, the very quick increases. We've never seen this in Canada before. We've never seen a 0.5% increase, let alone two back-to-back within, a month and a half of each other?
Full percent in a month and a half of each other. Yeah. Mm-hmm. It's a lot of change in a short period of time.
Yeah.
It's going to have an impact, Denny.
I mean, in no way is it going to benefit the housing
market. Let's be clear. The market has been slowing down since the last rate increase and over the last, say, 60 days. Every area and every product type and price point's doing something a little different. This further rate increase, we're going to see some people that are potentially rushing into the market that have rate holds that want to use those previous rates to secure a place. And then there's the new parties that may decide to wait. I mean, there's going to be a lot of headlines coming up. The cost of borrowing has gone up. The cost of $100,000 of mortgage has changed dramatically in the last few months. There was a period of time where I think you mentioned it would, on the lowest, you could get the cost of $100,000 mortgage was around $330, $340 per $100,000 mortgage. And now we're getting close to that upper $400-$500 territory. I don't know what the exact amount is, but it's more than $100 up per $100,000 mortgage.
If you're getting a fixed rate right now, you're in the low 4%, in the 4 to 4.5% range. And at those interest rates, you are in like the 525 to 550. Yeah. $525 per $100,000 of mortgaged money. If you are getting a variable rate right now, moving forward, you're going to be working off 3.7 prime. So your discount is probably going to be in the 0.6 range right now. So you're going to be at about 2.9. And that cost per $100,000 is going to be in that mid to high 400s range.
So 3.7 bank prime rate. Are you saying variable being around prime minus 0.6?
Yeah. I mean, a year and a half ago, we were seeing discounts off prime at like 1.1-ish. That was kind of the lowest. I saw 1.15. But now those bank discounts have tightened up a little bit. And as of as of a couple weeks ago, I was seeing minus 0.5, minus 0.6.
Yeah, I agree. And how about the fixed 5-year mortgage? What were the lowest rates that you can recall seeing, call it a year ago? Because they were around 2%. And there were some cases where they got under 2% for a 5-year fixed.
I think the lowest I ever heard was 1.4 or 1.5.
No way. Yeah. 5-year fixed at
5-year fixed. I had a friend get a 1.69, I think.
Oh, my.
But I heard a couple of consumers. Ridiculous. I think it's kind of one of those things where having a larger down payment doesn't necessarily help you in the mortgage world. But if you are getting if you put less than 20% down, your mortgage is insured, the banks are likely to give you a better rate. And at these super low rates, I saw some insured mortgages get in that 1.5.
I was anticipating you saying 1.8, 1.9, which is still low.
I know.
Yeah, that is. Congratulations to whoever has a mortgage at that rate. To Denny's friend. So Denny, the market has been slowing down recently. It's been easing up since the last hike. We're coming off like a record market in terms of activity. It's been the craziest sales market when I look at some data over the last 12 months that I've ever experienced. What do you think is going to change over this summer? We have June, July, and August ahead. How do you feel June and July are going to feel after this latest announcement?
I just think there's going to be more inventory. I think that's going to be the biggest change. I think sales are going to be slow and steady. I don't think there's going to be another big price drop. Like, I think we've seen that for 2022. I don't think this is going to help activity in any way. We were kind of chatting about this at our team meeting yesterday, that a lot of buyers in the last 30 days or so have this attitude that I'm going to wait and see what happens. And another 0.5% increase in interest rates is not helping them, jump off the fence and get into real estate. It's going to make them wait again and see if prices come down this summer and this fall. I wouldn't be surprised to see, those sellers in tough situations, whether they've purchased something already, whether they have a pre-sale coming up that they need to complete on and need some funds out, whether life changes, going through a separation, whatever that may be. I wouldn't be surprised if there are some deals out there for people that are looking to buy. So those prices could come down a little bit, or throw a really low benchmark into a neighborhood. But I think there's a lot of sellers that are in a situation where they don't have to sell and they're not going to be chasing markets down. So I just think inventory is going to build up. There's going to be a lot to choose from if you're a consumer. And there's going to be some situations where low sale prices hit, but I don't think the typical single family home is going to continue to drop.
Yeah, I guess kind of putting it into a different perspective, if they did no rate change and we were still at, a bank Canadian prime rate of say 2.7, 1% lower than it is today, I think there's a scenario where the market could have run another 10, 15%. So this rate hike has checked the market. We've already seen some incidences prior to this rate hike where, say, a townhouse that was $900,000 last August bumped up to 1.2 million in February and is now at $1.05 million. So there's already instances around town where 10, 15% corrections have taken place since February. My thought is that this latest announcement is going to create some fear. Some buyers that are not anxious to buy might sit and wait. Some buyers that have rate holds might anxiously buy. But on the supply side, I think the less motivated sellers will show up less. The anxious sellers will still show, and there will be some sellers that have to sell quickly that might get caught up in this weird next 30 to 60 days of uncertainty. So if you're a seller that's in a situation that's a little bit dire and you have to sell quick, recognize that over the next, I don't know, it could be 1 month, could be 3, could be longer, but over the next little period, there may be scenarios where you have to discount a little further. I would be surprised if you're discounting to pre-last summer prices or even getting to last summer prices for like entry-level homes and townhomes. So it's more like we're getting back to, I don't know, November prices, October prices, which isn't that long ago. So I anticipate a slowdown. I think on the stats level, we already saw the market ease. April sales were 1.5% above the 10-year average. And for the last almost 2 years, I think it was like since around June 2020, the monthly sales have been raging well above the 10-year average, 30% above, month over month, more sales than our typical market. And I think what we might find, I don't know if it's going to show its colors in May, or in the May stats, but I'd say July stats are going to be below the 10-year average in terms of sale volume. I think there's areas where certain property types that are more of a commodity that aren't as short in supply, I think they could get hit another 5 to 10%, and just in this little short glitch. The thing that I'm going to be watching closely is where the inventory levels are at in July. I tend to find that if inventory is the balance of supply and demand, if the market is truly showing, it's going to start showing its colors in July. And what's happened in the past, when I look at where inventory started really flooding, is 2008, which is a long time ago, comes to mind. In July, there was listings building up, and the fall crashed in 2008. I don't anticipate a crash, but I could see a slow fall being a scenario. It's hard to say, but I think the one confident thing is it's unlikely that the supply of a single-family home or a townhouse in a lot of markets, or in condos in some markets, are going to be oversupplied, and the new construction costs are still very high. So the only thing that kind of keeps the prices in check is a pinch in supply. The only thing that's not short in supply is luxury suburb homes, $3 million plus suburb homes. Anyway, that's my rant, Denny. Any disagreements? Anything to elaborate on there?
I don't think so. I think these are unprecedented times. It's kind of exciting to predict and see what happens over the next few months, but it's a little bit of a guess.
It is a guess. And if they do another rate hike, it could get ugly.
Totally. Yeah. I think you're right. I think the biggest change we'll see looking back for the last few months is just sales volume will be slower. There could be another 5 to 10% drop in some product types, like potentially land value stuff. But I think the biggest thing is just there's going to be less sales. Yeah. There's less activity. When the overall buyer consensus, like from a number of people that we've chatted with in the last 30 days, is I'm going to wait and see. Just more people are sitting on the sidelines, less buyer pool, less people coming to showings, less sales.
I think just kind of highlighting some products that are likely to get hit worse. Land value, I would assume, and a lot of markets, I think builders are going to be a little more patient with acquiring land for their next build. I think luxury detached homes that are at high price points in the suburbs. I think the busy street home or the home with the weird layout is going to get affected. What I think is going to be least impacted, I mean, Yaletown condos. They seem to be around 2017 prices and well below replacement value. Call it around $1,100 a foot compared to new construction starting at $1,500 a foot. Just based on recent experiences, like a solid house in Lynn Valley, I use Lynn Valley as an example, but if you have a 3,000 square foot home on a quiet street in, say, North Vancouver, there's so much demand for that. I anticipate those prices will hold. And I say that just because of how strong it is, the seller's market in some of those areas. So certain stuff, if you've been looking for a detached home and call it North Van or New West or wherever there is a lack of single family homes, and the right one comes up, I wouldn't hesitate to go for it because the supply and demand is way out of whack. But if you are an investor looking for, say, a luxury home in the suburbs, which would make a weird investment, or just like a generic townhouse or condo in the suburbs or valley, you have a little bit more time to make a decision.
I think, honestly, the next 6 months might be a super good time for people to upsize. The gap between that townhouse that went from, $950,000 to 1.3 back to 1.2, the gap between that and that entry level home has narrowed quite a bit in the last 30 to 60 days.
I think that's the takeaway of this episode. If the markets like this are great markets to upsize. So for those that are within their affordability, that are not like stretched by a stress test and putting themselves out to the limit, if you can afford to upsize and you plan on upsizing, down markets are good markets to do that in.
You're getting a 10 to 20% discount off of that house from 3 months ago, from 2 or 3 months ago. Sweet. Let's see what happens.